Well, greetings, class. We're back to part C, and we're going to talk a little bit more about loans. We looking at personal loans. We're going to look at advantages and disadvantages a little bit. But looking at the advantage of loans, basically it consists of be able to gain large sums of money that you don't have, and so you can pay so much per month, and so you can actually borrow money for like mortgage or buying a business, and knowing that you can pay so much per month for a period of time. It's important to build your good credit rating when you do your personal loans. Also, the other things involved too is that it helps you to find a source to enable yourself, individuals or businesses to advance in their projects, programs, or things that they want to get accomplished. Remember that in some situations, that is, you can negotiate your terms, especially if you have a good credit rating and you have good assets to back up your loans. Keep in mind that usually a written contract or written guarantees will access the funds, and repayment agreements signed by you will then you may contract with a bank and yourself so that you have the funds, and you also agree to pay back by what the agreement says. Interest rates is varied depending on institution and also by the type of economy we're in at the time when you apply for a loan. So personal loans can also be obtained for a variety of reasons, depending on what you need. And then also remember, student loans usually carry a lower interest rate, which is good, but you still want to make sure you use those wisely, because again, the rule of thumb is to try to only use it when you're in an area that you know for sure what you're going to go into. The disadvantage about loans is that, well, you have to pay the money back on a timeline, which that's always a hard thing to do for some people. But there's a timeline set up, and you have to be able to make those payments per month or per quarter, per year, depending on what the agreement is. Usually the institution will set up a repayment schedule for you with a minimum payment. You can pay more if you want, but there's a minimum payment you have to pay per month on a certain time and day. Interest rates, like we told you before, may be high depending on the times, the conditions, the economic conditions at the time, or it may be low. And just remember, borrowing money is not free. It's not free money. You still have to pay it back, but you have to pay an interest to use that money. That interest is what kills a lot of people, though. And to make sure that you look at how much interest you're really going to pay. Of course, the lower your credit score is, or if you have a poor credit score, the more interest you're going to pay on a loan. So possible sources for personal loans would be things like your local banking institutions, your local credit unions, colleges and tech programs. For student loans, those are possible sources for personal loans you can get. On the application of a loan, you look at, a lot of times they may call for a balance sheet, especially if you're in business, or an owner equity statement. Basically, the owner equity statement or balance sheet shows how much you have available that in case they have to come and collect from you and you don't have the money, they can collect assets from you to get paid back. The other thing important is your credit rating, and you want to make sure you have a good credit rating before you even try to apply for anything at all. We find out now that in today's world, now employers are now checking credit ratings because it's an easy thing to find out if the person is responsible and they pay back what their debts are, and they're not they're not in overhead in water or debt, that they would maybe not be a most dedicated employee. And so be aware that your credit rating now is in the market as far as being used to hire you. So you want to make sure that credit rating is in good shape. And also other things they may look at is employment references as well. The credit rating will keep track of your past credit history, and that's what it talks about, and then it rates you on it. So whatever you have, if you didn't pay one loan off, that drives your price down. If you're late on your payment, that drives your interest score down. Those things drives them down, where you're paying off debt and have, as we talked about earlier, a good debt to income ratio. That also brings your score up too as well. You can see a 3-in-1 credit report. There's 3 agencies that takes care of your credit scores, and depending on what credit score that they ask for, or depending on which one they use, you could use all 3 or 2 or 1. And so you want to make sure you check to make sure you have a good credit rating. Particularly this one, for example, 730 is really the ideal that you want to try for. It's excellent rating, excellent history, payment history, excellent amount of debt, excellent in credit history and length of it, and amount of new credit is excellent. So this person had a 730 score, which tells them they're pretty responsible. And so that's something that you have to keep in mind about credit score. We talked to you a little bit about unsecured loans last time, but understand secure loans are those that need collateral. So you have assets that you can put up in case you don't pay it back. The bank or the institution can come and collect those assets from you so they don't lose money. That's why it's a secured loan, because one way or another they're getting their money back. Unsecured loan, remember, it's like a signature loan. They're giving you money on your signature, on your history, saying that you're going to pay them back, on your promise you're going to pay them back, and it's based on your credit rating. The lower your credit rating, the higher interest rate you're going to be paying. And then when you loan interest rate, remember that you have to look at how they determine your interest rate. Most places will use the APR, which is the annual percentage rate. Some may use simple interest or add-on method or discounting interest, depending on the terms of your contract with them. Be careful with these loans that say 0%, because a lot of times they have an add-on method to it, where they kind of add on the amount, how much they're not telling you. They have an add-on method, and so you're not really getting that loan for free. You're paying somewhere in that loan something. And that's why you always use your bank and maybe that dealership you may go to compare, because a lot of times you find out even though you're paying like 3.5 interest at your bank, your interest rate is still lower, and that's because they don't, most banks anyway, and credit unions especially, don't put on an add-on method or other types of interest rate add-ons to it. And that's in the part C. We'll see you in a few minutes to finish up with part D. Thanks.